So a lot of investors would agree that kind of the holy grail of investing from the long-term perspective would be to find the next Berkshire Hathaway. Berkshire Hathaway has delivered roughly 3 million% total returns. That's not misspeaking, actually 3 million% total returns since Warren Buffett took over in the mid 1960s. There are a few companies in the market that are comparable to an earlier stage Berkshire Hathaway. Not that any of them will completely replicate that performance, but Markel is pretty close in the sense that its business model is similar. Berkshire is insurance, it has some subsidiary businesses, it has an investment portfolio, and Markel's a pretty similar company. It's a specialty insurer that also invests in early stage companies through its venture capital business, and it also has a stock portfolio. And it's worth noting that both companies own the other's stock. Berkshire Hathaway is actually Markel's number one stock position in its portfolio, and Berkshire has been adding shares of Markel in recent quarters. So I brought my friend Tyler Crow here, who is a big Berkshire Hathaway fan and actually joined us at the Berkshire Hathaway meeting this year. Um, Tyler, first of all, do you own either of these stocks or both of them? And which one is your favorite right now?
Well, I do own Berkshire Hathaway. I do not own Markel, but I'm gonna be honest. If I had to pick between the two, and I were to make a capital allocation decision right now, I might go with Markel. And much of what I would be, the reason I would be doing that is actually just purely on valuation. Valuation is really tough for these businesses. You and I have kind of discussed this offline and other places as well, but like you can't really do book value because there's so many depreciated assets and so many things that are just sitting on the books that we don't really know what they're worth. You can't really do earnings because, the equity interest in things like, for example, Berkshire's stake in Apple, things like that, it fluctuates and it has to be reported as earnings. So you don't really know what's earnings and what isn't. So the best stab I can take at it is kind of looking at it from a cash flow perspective. Like how much free cash flow are these companies spitting out on a per share basis? It's not a great valuation, but lack of others, it seems to be the best one that we have. And as of right now, Berkshire Hathaway currently trades for right around 31 times free cash flow. That's a pretty expensive valuation on a cash flow basis. Comparatively, Markel Groups trades for 7.7, which is cheap. Even being a relatively conservative investor, free cash flow less than 10 is a pretty conservative metric, and it suggests pretty cheap. Whether or not Markel is headed for some downturn where it's going to have huge cash outlays, I don't really necessarily know. Because much like Berkshire, Markel's insurance business, I don't know what kind of big insurance outlays it may have in the upcoming quarters, or if it's planning on to make some big splash acquisitions. But if you kind of look at the free cash flow pattern of Markel, it has been steadily increasing over the past 10 years. It's not like this lumpy thing where it's like, oh, $20 billion one year, but then negative the next. And so, if based on this, I think I might be a little bit more compelled to go to Markel. But it's, because of valuation and as far as a business, they're not wholly dissimilar.
Yeah, like you said, the valuation is really tough. And it's not a direct comparison. You mentioned the free cash flow, and I'll kind of just argue the other side of that for Berkshire in that the stock portfolio makes up a lot more of Berkshire's market cap than Markel as a proportion of the business. Berkshire stock portfolio is nearly 50% of its market cap, and that's not reflected in free cash flow figures for the most part. It also distorts its earnings even more than Markel's because, unrealized gains and losses are reflected there. So I would say the better buy really depends on what your goal is. I don't think you'd go wrong with either one. Berkshire is the safe business. It's really tough for me to visualize any scenario where 10 years from now, Berkshire is worth less than it is today. It's really tough. The stock, whenever Buffett is no longer the leader, it might take a temporary dip. I would say that's fair to expect. But I don't see any scenario where it's worth less. I can't say the same for Markel, where it's there's nothing that's a sure thing, but it's much less of a sure thing over the next 10 years than Berkshire Hathaway in terms of the business being worth more than it is today, although I think it will. I don't think Markel's going to deliver 3 million% total returns for investors in the next 50 years, but it is an earlier stage business. It can invest in things that won't move the needle for Berkshire. Like Markel Ventures wouldn't make sense for Berkshire, because even if one of those was like a 10x, what would it add? Maybe 0.1% to Berkshire's market cap. So there's a lot of things that Markel can do that would have a meaningful impact than that Berkshire can't. And Warren Buffett himself has said that the biggest handicap is Berkshire's size in terms of delivering outperformance over the next 10, 50 years or whatever. So I don't want to give a definitive answer. If I were going to put money to work today, it would probably be in Markel. But both are similar sized positions in my portfolio right now. I think Markel might be a little bit larger. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.